talk about what it takes to purchase a home as a first-time home buyer or someone that hasn't owned a property in 3 years. I am going to walk you through every single step, which, as you will see, it's very straightforward. I always have this conversation with my first-time home buyer. This is from a perspective of a real estate agent. I've been in the business for 8 years right here in Southern California. I do own properties as well, and I've helped hundreds of clients buy, sell, invest, etc. Now, how it works with the bank is typically they want to see employment history and stability. And to them, they want to see 2 years of either the same line of work or the same employer. They also prefer a good credit score. Now, depending on the loan type you're going to use, good credit is going to be different. If you're looking at an FHA loan with 3.5% down, which a lot of first-time home buyers utilize, especially when you have a higher debt to income ratio, the minimum credit score requirement with 3.5% down is going to be 580. Now, if you want to have a better interest rate, this is where things change, and I would advise on having 650, 680 and above. Debts are considered on a purchase. The bank will look at your car loan monthly payment. They don't look at total debt, only monthly payments towards your debt. So car loan, car lease, they are both equal. Credit card payments, the minimum payments that is due every month. Student loans, yes, they will look at your monthly minimum student loan payment. Now, if you have it deferred, there's a different calculation that goes into that, but it still gets. If you have any personal loan, of course, the monthly payment will be taken in consideration. And what happens is your monthly debts, your monthly payments towards your debt actually takes away from the monthly payment that you can have on a mortgage. So let's say with your income, you qualify for a monthly payment of $4,000, but you do have $500 in debts. Well, now you would only qualify for a payment of $3,500. That is a rough estimate, but it's just a simple breakdown for you to understand how debts work. What debt to income ratio is best to have? Now, a lot of people will say 30% of debts. And when I say debt to income ratio is how much of your mortgage payment do you want to consider as a part of your whole debt into your income. So again, if you are making $10,000 a month in gross income, some might say 30% is a very safe place to be with your mortgage payment. So you make $10,000 a month, but you would only allow yourself the $3,000 mortgage. Because as a reminder, in your mortgage payment, you do not have utilities, you do not have life expense, none of that is in the payment. What you do have in your mortgage payment is gonna be your principal and interest, home insurance, property taxes, if there's any HOA that might be in there as well. You have an escrow impound account. Most banks will allow you to have a debt to income ratio of 45%. So 45% of your income going towards a mortgage. And in some exceptional cases, when I have seen just one borrower do this, it was actually years ago, back in 2019, where a buyer purchased a home and utilized 55% of their income to qualify for the property. Now, that borrower didn't have any debts at all, had a lot of funds in reserve after the close of escrow, and they had exceptional credit score. Again, this is to the discretion of every lender. Can it be done? Yes, under exceptional and special circumstance, it is possible. As I mentioned, this borrower didn't have any debts, had pretty much the best profile possible for the bank. So the bank felt confident letting this borrower do this. But generally, I've seen a lot of first-time home buyers, especially when it's more than one income that is going to be on the mortgage and they do have some savings, go with 45% of their income. But again, that is the discussion I highly encourage for you to have. If you're purchasing with a spouse or by yourself, you really want to take all of that in consideration. Next is, what are the items that are required from you, the borrower, the buyer, to provide to the loan officer, to the bank, in order to get a mortgage? Now, as I mentioned, having employment of 2 years, and how you show proof of that is through your taxes. So taxes for the past 2 years, filed taxes, W-2 or 1099 if you're self-employed. In the initial part, typically when you are on a W-2, they request 2 months of bank statements. Now, self-employed, it might changes depending on your business, but we're not gonna go into details into this video. On this bank statement, they wanna see pretty much all the pages for the past 2 months, and just a little information out there. They prefer PDF form, although, I mean, if you have it printed, that's fine. You will need, obviously, pay stubs for at least 1 month if you are on a W-2. Once you have that, and of course, a form of ID, so that could be your driver's license, a passport, something of that nature. Once you provide all those documents to your loan officer, then you're going to be doing a loan application. Typically, that's going to be online. You're going to be asked personal information, providing your documents through the form there, and you're going to sign the loan application, and that pretty much will give you, if everything checks out, everything makes sense, that is also where you're going to run your credit. If everything makes sense and you want to move forward, this is where the loan officer is going to issue a pre-approval letter. Now, there is quite a distinction between a pre-approval letter and a pre-qualification letter. Anybody can get a pre-qualification letter. All you need to do is to call a loan officer and tell them over the phone, you make this amount of money, you have this much debt, this is your credit score, and they can issue a pre-qualification letter. Now, I believe before 2008, that was pretty much satisfactory, but nowadays it is not. We, us real estate agent, listing agents, we want a pre-approval letter because we want to make sure that your loan officer and lender, bank, whoever you decide to work with, has verified all of your sources, maybe even done a verification of employment. And we want to make sure that when you submit an offer, you are actually pre-approved. Now, I'm going to give you a breakdown of the process and what you should expect as a first-time homebuyer. So, step number 1, you want to get pre-approved. Now, although I did just say step number 1, you can find a loan officer to work with first, or you can find a realtor and they will recommend loan officers for you to get in contact with and start the process. But going either way is fine. Once you get pre-approved, you have the choice of selecting the loan officer you want to work with. So here's a list of who you can work with. You can work with banks, credit unions, direct lender, or mortgage broker. Now, there are some differences into which source you're going to utilize. Now, banks, in my experience, and working, talking, and even myself personally getting pre-approved with a bank, I have to admit they work mainly with elite home buyers. So buyers that have, I would say, perfect files. And what do I mean by that? Buyers that don't have any gap in their employment, that have a very good high credit score, that typically have a lot of funds in their account, and that have stable employment, as I mentioned, and typically are coming with maybe the minimum or heavier down payment. Again, this is something I have noticed with years of experience. It's my personal experience as well, but I just want to spread awareness. Now, are banks great to work with? Yes, they have their benefit. If you meet their satisfaction, their guidelines, they'll give you a great interest rate. That is without a doubt, but you need to meet all these guidelines that I have just mentioned. Next, we have credit unions. Now, I have spoken about credit unions several times, not here on my YouTube, but on my Instagram and TikTok. Credit unions are incredible because they give very, very good interest rate, because credit unions are not looking to make any type of profits or even any type of money out of the mortgage loan they give out, because they are owned by shareholders. So this is why they give very good interest rate. Now, last, you have the option to work with direct lender or mortgage brokers. Direct lenders are great. You will get a good variety of loan availables. They are also good because they typically work on their own schedule versus bank and credit unions where they only work 9 to 5, and getting a hold of them on the weekend might not be possible. And typically that's when a lot of home buyers are looking at houses is on the weekend, so something to be aware of. But mortgage brokers in general have a very big access to a wide variety of loans that are might be backed by Fannie Mae, Freddie Mac, but also by investors. So you're gonna get a very big pool of loan options, and even something custom maybe to your needs. So that's why when you might have a gap in employment, your credit score is not that great, you might need assistance with the down payment or closing costs, direct lenders and mortgage brokers are great to help you out with that. They do offer those loan products. That covers pretty much the pre-approval. So what's next? Once you're pre-approved, this is where pretty much the fun start. I always tell my client this is when we're excited. We're going out to see houses, preview property, view homes, and this is when typically home buyers know right away after they walk through a house if they like it or not, if there's something that they would see themselves and their family live in or absolutely not. And once you view houses, this is when you find the best of the best and something that you really like. After that, it's going to be submitting an offer with your terms to the owner of the property. And this is when some of the negotiation will happen. Negotiation with the price, closing costs, credit, repairs if there's something very obvious, maybe some furniture, maybe if it's an Airbnb, you're gonna ask to have the pictures and you wanna take a look at their calendar, etc. You can request a lot on your initial offer. And I want to mention this is definitely something for 2024. I would not put so much into an offer if it was back in 2020 when there was no inventory, and it was very hard to get an offer accepted. So just keep in mind, the market in 2024 is definitely different. There's more inventory, there's less buyers that are currently on the market, as we're 2 weeks and a half away from Thanksgiving. So just keep that in mind. Once you submit your offer, the seller has 3 options. Just keep that in mind as well. They can accept it as is, which that is the perfect scenario. And every time I have a first-time home buyer that sends an offer and gets accepted as is, they get freaked out. It's like, whoa, how did this happen? Like that's something strange. Like, it shouldn't work that way. Like, maybe, and then they start having doubt and having cold feet. But it has happened to me so many times, and it's always such a great feeling when a first-time home buyer sees like 1 or just like 3 houses submit one offer and gets it accepted. That is great. Is the perfect world for everyone. Don't get freaked out if it happens. Actually, congratulations if that happens to you. It's a blessing. The next scenario is they can send you a counter offer, where pretty much on that counter offer they would make a list of their terms. So they did take a look at your offer. This is your term, this is their terms, and are you willing to accept that or submit a counter offer to the seller's counter offer? That's again where there's going to be a lot of negotiation on different terms. And the third option is the seller just declines or doesn't even respond to your offer, which is extremely unfortunate. And it's disappointing when you don't hear back from a seller, but it's definitely something that can happen, as a homeowner has absolutely no obligation to respond to your offer. And that is just how it is. There's no law, there's no binding contract, anything. So keeping that in mind. So once you get an offer accepted within any scenario, the next step is going to be doing your due diligence. Now, what are some of your due diligence? You're going to want to, no matter what type of home you purchase, a condo, a townhome, a new construction, you want to do a home inspection. Because the home inspector's job is to tell you everything that is wrong with the house. And what do I mean by what is wrong with the house? Everything that might need to be replaced eventually, and maybe something that's on its last years, or something that doesn't work, or something that hasn't been installed properly. The list goes on and on and on. And you would rather be aware of it, even if it's something, an item that doesn't need to be addressed immediately within the hour or within the day, is something you want to be aware even after you close escrow, because purchasing a house is a big asset. Is if you're going to have to replace or repair something, it's going to cost money, and you want to be aware, like, hey, down the line, maybe the water heater has 2 more years. Okay, so if that's the case, maybe you should get a home warranty to make sure that if eventually it breaks, at least you're covered under the home warranty. Now, once you do your home inspection, you also want to do, or you can ask the seller to do, a termite inspection. We live in Southern California. We have, although beautiful weather pretty much all year, we do have crazy weather, especially these past few years. I don't know what's going on. We have the winds, we have crazy rains, we have, sometimes even monsoon in the desert. And all of that beautiful weather, crazy weather. If you're in the beach cities, there's humidity that attracts termites. Now, not just termites, there's different types of termites. It could be dry rot, it could be others. I'm not a termite specialist, so I'm not going to go into details with that. But again, it's an inspection you want to have done either by you, where you cover the cost of the inspection, or the seller. Now, again, that's the best of both worlds, where the seller does the termite inspection and the clearance if there's any findings. And most houses where I have represented a buyer or a seller, most houses have had termite, some type of termites. Now, the cases where I don't see any of these little bugs on properties is when a owner has their property pretty much maintained throughout the year, quarterly or whatnot, and they do those types of maintenance and they take it pretty much at heart. Those are the cases. Now, a lot of owners don't do that. I personally do it, especially as a Airbnb host. It's something that I rather have maintained every month than one of my guests coming to one of my properties and then they find something that, you know, could be big trouble. Next, when you're in the escrow duration, when you're getting a mortgage loan, of course, if you're purchasing cash, pretty much everything that I've said through the video doesn't concern you. But when you are getting financing, the bank is going to send an appraiser. Now, the appraiser's job is to ensure that you are not overpaying for the house or underpaying for the house. So they are going to establish the value of the property. Your loan officer will order that appraisal, and so they will tell you the value. Now, let me give you an example of what can happen. Let's say you're purchasing a house for $500,000. Now, in the case where the appraiser says, well, the house is worth $485,000. So you have a few options. You can ask the seller to reduce the purchase price, to make a new agreement to the $585,000 purchase price. Again, the seller can say yes or can say no. You can do that. Now, in the case the seller says no, you can cancel and walk away, because per the purchase agreement, the agreement is made on the house appraising at the purchase price offer. So if it doesn't appraise at the value that you have offered, you can walk away within your contingency period, might I add, where you can still get your deposit back for the property. Now, another case which has happened a ton in Southern California, you offer $500,000 to the owner, you open escrow on that purchase price. Now the bank comes back and says, well, the house is worth $535,000. Now, in that case, your purchase price doesn't get corrected. And if that were to happen, what happens for you as a homeowner once you close on the house is now you would have additional equity on the home. You don't have to go and renegotiate the price with the seller. That is not something that is a rule or a law or anything like that. So once all of your due diligence are done, your home inspection, termite appraisal, that is also a period. Let's say there's a lot of repairs that are needed on the house. Again, that is something that you can negotiate with the seller, where they can give you a credit for the repairs, do the repairs, or even do a price adjustment. But in a very short manner, this is how opening escrow on the property and going through the process of the purchase, this is what you should expect. Once your due diligence are done, typically in that period, you're going to be finalizing the financing. So the loan officer makes sure that the loan is approved and you're ready to close. And pretty much after that, what happens is, congratulations, you become a homeowner. Now, this is very basic, straightforward home buying, home purchase video, there's of course a lot of scenario with things can go south, or things happen, scenarios where it might be more challenging. But this is pretty much a simple, straightforward way to purchase a home, to get pre-approved, to go through the process of escrow. And might I add, escrow is a third independent party right here in California. In the East, I believe they use attorneys, but not here in California. So escrow will be the third independent party that pretty much takes care of the transaction for the seller and the buyers and the real estate agents, brokers that are involved, aside from the loan officer. So I hope this was helpful. I am very intentional with the content I want to start putting on my YouTube channel. It's something I started years ago, and I have not been consistent. And it's something that that means a lot to me, because I know a lot of you guys really enjoy more details and a longer form of content, because of course that helps you understand more and have more information, especially about real estate. So if it's something that you like, please give this a like, subscribe. As I said, my goal between now and the end of the year is to post at least one video per week. Next week, we're going to be going over the FHA rehab loan. I have put some information on TikTok and Instagram where there's been an update where you can get up to $75,000 to do rehab on a property using an FHA loan with 3.5% down. So make sure to be on the lookout for that.